I'm Keith McCullough, and welcome to day 3 of the Investing Summit. This is our 15th, and it's been a great one so far. First 2 days, thank you to all of you who've joined us and for all the kind compliments and feedback and questions and back and forth. I quite like having these back and forths back to back to back, and today I get to start with a gentleman who is not in the USA, so he's going to have plenty of perspective and he's got plenty of experience, and it's his first time on HedgeyeTV from his new firm, Vulpes. Again, welcome, Steve Diggle.
Thanks very much, Keith. Great to be here.
It's good to see you. Vulpes, what is that, a fox?
It is a fox, yes. Yeah, we do a lot of different things. So we named ourselves after the cunning fox.
Before we get into it and your strategies, which are quite unique, but again, lots of experience behind them, very relevant to this day and age. And I do find it quite comical when people are just all talking about risk, but nobody's really ever managed risk, certainly not accurately. They can say that they tried and did so without any P&L or alpha, but you did. You had a huge run, like your first run in the not to date yourself, but I mean, all the way from, the 2000s. Let's just start with that and how it went for you, calling that 2008 definitely a market.
Yeah, sure, Keith. I mean, so I think the reason, if anyone's heard of me at all, would be that in 2002, myself and my partner Richard McGinnis, we set up an Asian-based hedge fund, principally focused around two things, which is capital structure arbitrage, which is just taking advantage of anomalies within the same corporate entity. So the debt versus the air stock, the convertible versus the equity, the warrants versus the options, multiple ways of quite tight arbitrages. But alongside that, we always ran a long volatility, short risk strategy. The reason for that is that arbitrage tends to become a bit problematic during periods of extreme volatility. So we wanted to always be benefiting from that. And we did okay between 2002 and midway through 2007. Not fantastic. We just went, we did okay. But because of our long volatility strategy, whenever markets did take a bit of a wobble, we did really well. So we had positive returns, but negative correlation, which was quite an unusual combination. And what it meant is when markets got squirrely in say August of 2007, and then positively fell apart in 2008, we made a great deal of money. So, our returns were kind of the opposite of almost everyone else. Certainly in Asia, we had this really good run. We essentially made almost no money between 2002 and halfway through 2007. But between the summer of 2007 and the end of 2008, we made over $3 billion for our investors. So, which made us the best performing, hedge fund in Asia, because most of them were down 50%. Because Asia really got clobbered in 2008, and so that was a great vindication of our strategy. We're probably the only hedge fund in the world that ever had like a 40% up year and then had 60% redemptions. But 2008, we decided not to gate. Virtually every multi-billion-dollar fund did. We decided not to, and so we were a huge cash ATM for people who invested with us. Narrowly, people thought we were stupid not doing that, but I think it was the right thing to do. I'd certainly be better off if I had gated like everyone else, but we sleep better as a consequence. But the problem for us after 2008 was, how do we match that? Because risk prices were through the roof. So being long volatility was extremely expensive. And secondly, we were never going to match the sort of returns we'd seen in the second half of 2007, 2008. So by 2010, my partner decided he wanted to retire. He sold me the rest of the 50% of the company I didn't own. We renamed it from our traders to Vulpes. And we shut the Vol fund down. And have been doing other things, largely private equity, venture capital in the region, a wide range of things. But we have stayed away from the long volatility stuff, which is really where we made our reputation, until earlier this year, when after 14 years after having shut those funds, we reopened them, which has caused some interest because clearly we're in a raging bull market right now, right? It's very strong indeed. And so why would we be doing it? Really, it's for three reasons, Keith. One is clearly valuations are a bit stretched. Everyone over the age of, I don't know, 40, maybe 35 can see that, right? I mean, it's a little worrying. I think most people with experience with markets are a little, at the very least, disquieted by this current rampant bull market. We're very uncritical, very animal spirits extremely strong, very little skepticism in the market. Secondly, we think that the belief in the Fed put is probably too strong. Yeah, I know rates are up, but after the inflation scare of 2022, when US inflation got to 9%, I don't think the Fed has as much room as people think if things start going awry. And I don't think, unless the economy is really causing problems, I don't think the Fed's going to come to a speculator's rescue. And thirdly, and this isn't a political statement, but the election of Donald Trump into the White House, whatever you think about that, is going to be a catalyst for volatility, because here's an individual and an administration that is determined to shake things up and do things differently, and so we expect more volatility, probably on the downside. We do not want to predict when it's going to happen. I think that's a crazy game. But what we want to do is we want to be ready for that. And what we have traditionally done in our previous incarnation is we would have these long volatility positions and do our very best, and historically successfully, to make sure we don't experience a great deal of burn on them. And we do it for a variety of ways: some arbitrage, some trading of our vol positions. But historically, we have managed to be long vol, and therefore leveraged exposure to a downside, but without suffering significant decay. And I think that's been the problem for a lot of hedging strategies, is they've just been too darn expensive. Being short this market's been terrible. Trying to pick where to be short is actually done even worse. I mean, the riskier companies have done significantly better than the market. So that's been very expensive. And this, with the exception of like 3 days in April, we really haven't seen a lot of volatility in the markets since COVID. So, owning puts has been very expensive, and so on and so forth. So what we think we have a superior way to hedge your portfolio, in that you will get significant leveraged upside from any dislocation of markets, but in the meantime, we won't be burning through time decay or theta, or however you want to call it, while we do that. And that's our mission statement. We did it once. We think we can do it again. And that's why we've relaunched these volatility funds.
It's a great story, and really, I mean, I think it obviously requires experience. I'm not sure everyone can completely appreciate what Steve's saying in terms of the burn or the cost to carry the positions, but it's generally speaking what I see people screw up a lot. Like when I was first going through your background, I thought it was actually a typo, but then it brought me back to where I was in 2001, 2002. Because we started our fund with like $10 million, and then we had to, through P&L, grow it to north of $1 billion, and it was like that daily. And it's an interesting thing. We have that one thing in common, right? Which was that time and space with a partner. Like I had to learn how to do that through all my fuck ups, through all my learnings. You have to learn through running the P&L. That would be my shortcut answer. I'm sure people are much more interested in your answer, what you learned then and today. Market structure is very different than back then, of course, but there's still that ground war that you have to deal with every day, so that you don't have that decay, so that you don't have that burn. Can you get into that?
Yeah, I can. I mean, you're absolutely right. The markets are very different. What's hot this time is different. But as a wise man said, markets change, people don't. And it doesn't matter how many computers you have, markets remain psychological constructs, right? And they are still driven by fear and greed. Right now, almost entirely greed. And people remain susceptible to irrational exuberance and fears. So although the structure of the market has changed, the opportunities that come up are kind of the same because people don't change, right? We have not changed significantly, though, these days what drives markets is slightly different. And certainly, maybe people argue, and I would have some sympathy for it, that maybe some intraday volatility that's not connected directly to economic fundamentals. Maybe the computer algorithms are less emotional, maybe, but if we're going to get a significant withdrawal of confidence in the market, it's going to have a big impact. So how do we do it? So if you're owning options and nothing's happening, they go down in price, right? So that's just inevitable. And anyone who's ever bought a put option knows, you go through this this cycle of euphoria and despair. Usually despair, because most put options, 90% of put options expire worthless. So, some genius says, well, 90% of put options expire worthless, so you should just keep selling them all the time. Well, that works until it doesn't, right? So within the context of how do you pay for your burn, they say you have to be deft. What we always used to do, and now we've formalized it in this new fund, is we keep a little bit, well, not a little bit, maybe a quarter of our inventory for what we describe as trading. So if we can buy it cheap and sell it for, a bit more, then we do that. Now, you don't want to do that with the whole of your inventory. The whole point about being long these things is not that you buy them for 100 and you sell them for 105. You want to buy them from 100 and sell them for 1,000. Because that does happen. The best trade we probably ever did was buy credit default swaps on Lehman Brothers debt. We were paying 24 cents for every $100 of that. And we got $91.65 when it came to auction in November of 2008. So that was a 430 times our money. But, so you don't want to take all of your profit, but you don't want to take none of it either. Because no one's going to thank you for buying the VIX at, say, 12, see it go to 60 and see it come back to 12, and you don't take any profit. So so the way we fight the theta is partly through what we would call arbitrage, and partly through actually trading a little bit of our inventory.
Yeah.
And by doing that in a disciplined way, and we can show we've got a track record of doing it, you can stay on the pitch. And I think, that's the problem for most people who get worried about these markets, is that, for institutional investors, it's really tough indeed, right? Because these guys are now measured against ridiculously tight benchmarks, right? And so there are, for active managers, it's like the worst possible market, right? Because you just have to keep buying things that are way overvalued, because you're just terrified that something that's way overvalued can get more overvalued. And so, these guys are under, tremendous pressure. And every time they think, now might be a good time to either take some profit, to put some, raise some cash, or even put some hedges on, it costs them, and they look bad versus an index that keeps going up. But I think for individuals, and particularly for family offices or people who have discretionary amounts of money, from time to time people get worried, and they buy some protection and they see it goes to zero, and they end up with with this regret. They say, oh, I'm not going to do that again. And you've definitely seen these waves of people who've there's always some pundit predicting this is going to be 1929, it's going to end tomorrow. And then 6 months goes on and nothing happens, or something happens, and then everything corrects itself because everyone buys the dip, and people go, well, that guy was an idiot. You've lost all your money on buying those puts. Don't do that again. We're convinced that the risk reward for buying downside protection now is pretty good, but you'd be crazy to think that just because you've decided to get bearish today, the world's going to get bearish tomorrow, right? This is a very powerful bull market. Retail investors especially have been incredibly well trained to buy the dip. It's been an incredibly rewarding strategy. As we saw in April, having faith in this bull market can give you a very significant amount of upside. So I'm convinced that the risk of something bad happening is much higher than most people imagine, certainly much higher than is reflected in risk prices. but I don't want to in any way predict when it's going to happen, because we started betting against the market aggressively in 2005, and we had to run those positions for 2.5 years before we even got a glimmer of hope. So I've
Yeah.
been well schooled in the fact that no matter how smart that your advisors are, or how clear it is that things are going wrong, markets can run on a lot further. And as John Maynard Keynes famously said, markets can stay irrational longer than you can stay solvent. And so staying solvent is the key thing here.
Yeah, I like that, staying on the pitch. Your point's well taken on people versus market structure. I always say, markets don't lie, people do, especially when they're making mistakes. But I mean, staying on the pitch, I think let's just stay with that for a second. And you're also using language that's very familiar to me, but I find it to be new to people, actually, because I have to, unfortunately, some days I have to coach people through like some of these you and I consider basics. Like what you said was, you think about your budget or inventory of basis points at risk. That's how I think about, like, inventory that you're willing to trade. A lot of people don't think about staying on the pitch by having that flex, right? I don't know. Well, I know that a lot of people haven't been taught that game. Like, to your point, if you're under the age of 35 and you have to play in this neutral hedge fund game, I mean, that's like playing. I would never play that game. I always say I'd never go run a neutral book. I'd be screwed. I mean, that's way too hard. I want to be able to move. I want to be able to use my experience, use my risk budget to get myself out of problems that I'll always find myself in, and stay. I love that. Stay on the pitch. Do you think, because your definition, you said a quarter. I typically take a core position of 1/3 and I'll trade around the 2/3 of it just to stay in the game, and that works for me. But I think we're talking about the same thing, which is X amount of a bet needs to be totally flexible.
Yeah, absolutely. Look, I think one of the things that people have learned in the last 10 years, and I think it's a mistake, is that there will always be liquidity if you want to get out.
No.
And we've had fantastic liquidity recently, and obviously with the growth of these computer algorithms, computer dominant markets. I mean, the depth of the liquidity of the market seems almost infinite. So I know an awful lot of people who now believe that they can, that when they want to change their mind, there'll be someone there to take their position. Now, in the hedge fund business, the single most successful strategy, not just recently, but in the history of the hedge fund world, has been these giant multi-strats, right? But these multi-strats, they're essentially using only one risk management tool, which is stop loss, which is when something has gone against it for a period of time, and they're pretty tight in some of these places.
Very tight. Way too tight for me.
down 5%, they're totally out. They're out, and you're fired, no matter how much money you've made for them. Now, the problem with that is you're using someone else's bid as your risk management tool. Now, for those of of us who are trading through 9/11, the markets didn't open, right? I mean, the market, the international markets did, but markets shut for like a week, a terrifying week. In 2000 in 1997 in Asia, we had lots of markets that shut, and didn't reopen. The Malaysian market, for example, not a big market for most of your viewers, I'm sure, but it shut, and we were seeing like huge gaps in the market. So I think one of the mistakes that it's very easy to make is, in the last 10 years, you can get seduced into feeling that you don't need what we would call a static hedge in your portfolio. You can change your mind. You can hit a stop loss. If it's down 3%, then you're out at 3.1. Well, that's only if there's a bid there for your whole position. What if everyone else is doing it at the same time? So I think one of the risks that is building up is that everyone assumes that they're going to be able to get out of what they want when they want, at the price that they may not like, but is going to be acceptable. There's no guarantee for that. The history of the markets is that when markets really become dysfunctional, they become illiquid, and you get discontinuities. And unless you already have that position in your book, so unless you have that put option or you have that offsetting position, there's no guarantee that markets will be able to give it to you just because you've changed your mind. So I think we've been schooled in an experience where your portfolio has to be resilient to a shock without you being able to trade. And that's how we build our portfolio, is that we don't assume that there's going to be someone who's going to sell us, a downside put option at a great price, on a day we want it. If markets gap down, and all these stops, go off, then markets could become pretty discontinuous pretty quickly. We got maybe a very slight hint of that in the first 3 days of April. But if something was to be more serious, then we could see what we saw in the first 3 days of April times, I don't know, 3, 4. I mean, I think that the amount of liquidity and the amount of trading in markets now, the number of participants, from retail to passive, who would be trying to sell in a severe downturn, could just overwhelm the markets. And the role of passive has also changed. Like, over the last 10 years, it's just grown and grown and grown. And whilst it's been a very successful strategy for, obviously for Vanguard and their like, and for individual investors too, because they've had great performance by paying very little fees, it does create a risk that if markets become unbalanced and these gigantic passive funds have to be selling, the amount of selling that they could be doing could completely overwhelm anyone trying to buy the dip. Yeah. And we could get this, this doom loop, which people talk about. And I think it's a real risk. Like I say, I wouldn't want to predict it, but I think that the passive, which everyone thinks is just, the answer to all of their problems, great, you get first-rate fund management, at a massively discounted price, which to a certain extent is true, right? Because you just get to aggregate everyone's bets. Once, and that's certainly helped drive this bull market. It could also drive a bear market. So, we worry about discontinuous markets. And one of the things I would always say to people is, you can't guarantee that you're going to want to, that you're going to be able to get out of things you don't want. And so a good thought experiment to do to your portfolio every now and then is, what if all trading stopped in perpetuity? Would you like what you have? If suddenly markets all became private, and if you hate what you have, then you're not an investor, you're a speculator. Yeah. And obviously, certain things like crypto, are essentially, non-yielding, speculative investments. And if you had to hold that for 10 years, you probably wouldn't think it was a great investment. On the other hand, you take a stock like Pfizer right now, which has been beaten up badly and is currently yielding 7%. Well, I wouldn't mind holding that for 5 years or 10 years or maybe forever, right? So, one of the, it's not how you should run your portfolio, but it's a good thought experiment to do to your portfolio. Because if you hate what you own, as in you have to own it for 10 years, yeah, you're probably just, well, you've got to, I mean, look, there's nothing wrong with being a speculator. Speculators is perfectly legitimate involvement in the market. But, when people tell me they're invested in certain things, I'm like, yeah, you're actually just speculating. There's nothing wrong with it, but you've got to be clear that there's a difference between investing and speculating.
Oh, huge difference, yeah. I love that too, discontinuous. How many people, let's go, and it's not an age thing, but it kind of is. Like, again, the concept of discontinuous markets, which I'd never heard that before, and those who exclusively trade 0 days to expiration or just weekly options, there is no world where the market could close for 2 days, never mind a week. I mean, that's not. Yeah. That's to me what's most fascinating about the vol space is that you have this. You appropriately identified it, and I used to work in it. I used to work at Magnetar, which came out of Citadel. And Magnetar, of course, thought that they figured out, through Mars or the Magnetar Aggregated Risk Management System that, what they thought could be better than Citadel, whatever. Fast forward to today, they all essentially have the same factors, the same parameters, the same rules. And to your point, like every PM on their platform has to live within those rules. I mean, my entire process is built to front run those rules, by the way, because to your point, everybody doesn't get out at the same time. They actually all have to react at the same time, where we want to be doing the opposite. So you have that, but then you have this loony bin thing going on with people just YOLO you got 30 to 40% of daily options flow can be Well, 70% some days can be just 0 days to expiration options trading, but 30% of the total, 40% of the total flow could be investors who have never seen a legit and ongoing bear market.
Yeah, and Keith, if you look at history, the only time you saw such a big percentage of volume being represented by short-term retail investing trading was 1928, 1929, right?
Really? Like
Yeah,
so I always
sure.
go.
Those curb brokers and so on. They were representing 3 or 4 times the volume that was actually on the floor of the New York Stock
Really?
Exchange, right?
Okay.
Yeah, it was happening outside. Yeah, go check it out, right? I mean, what was happening in 28, 29 was like, there was more off market trading going on. So-called curb brokers who were literally dealing about the back of their truck, than there was actually on the market. So we have not seen this level of speculative retail driven activity as being such a heavy percentage of the markets for a very long time, almost 100 years. And of course, it did not end well. I'm not predicting, a 29 style crash. I don't think that's going to happen for various reasons. But, it certainly should be in people's wheelhouse of possible outcomes. Now, when we talk about modern portfolio management, the last time we experienced this sort of groupthink was in the years leading up to 2008, when we had this VAR, this thing called value at risk, which everyone became enamored with, and all the investment banks were using it, and so on, right? And well, I won't name names, but a couple of very famous investment banks, were telling their board, that their value at risk was, say, I don't know, $100 million. And then they had a report like on one day they'd lost 4 billion, which back in those days was a lot of money. And they're like, how can that possibly happen? Well, it's like, it's outside of our parameters of normal value at risk. You're like, okay, that's because you're making assumptions about correlation, and diversification, and all of this, both correlation and especially diversification work really well, except in times of extreme stress.
Yeah.
So diversification works not, owning 30 different things is normally a great way to spread your risk. But in 2008, it didn't work at all because everything fell heavily all at once.
Yeah.
And, if you were doing that with, leverage or borrowed money, you were carted out at prices that you couldn't control, because you had, by taking either leverage or debt or both, you'd lost control of when to make those decisions. So, a lot of what's happening in the short dated zero day option speculation is all it is, right? It's not, no one's investing. No one's calling that investing. It is very similar. So, it's adding a great deal of liquidity right now. But I think, in terms of, it's like this dry brush, right? You don't really notice it, but that's what catches light and leads to the forest fire. Mm-hmm. It's not the mighty trees. We're not going to wake up tomorrow and find, Google's down 30%. What's going to happen is that, these smaller, riskier strategies and positions are the things that are going to start to get liquidated. And it might just fizzle out. But the amount of sort of dry brushwood that is now currently on the forest floor, I think, is quite terrifying. So, when we say, people say, well, what's going to cause it? And I'm like, look, I can give you a list, right? Political tensions between China and the US in the Taiwan Strait. Russia decides to invade another country. This, that, I can go on. A massive solar flare knocks out, vast amounts of our of our tech space, whatever, cyber attacks. I can just go on and on and on. The fact is, I have no idea what will cause the next batch of, aggressive profit taking and possibly, severe market stress. But I really think on a probability basis, the chances now are higher than they've been really since 2007, 2008.
Yeah, I'm glad you said it that way, because so many people, first of all, the question, according to me, is born out of the disease of the human mind. Like, the human brain wants certainty. They want to ask Steve Diggle when, and they want you to give an answer. Now, if you and I worked at Goldman Sachs or JP Morgan, we'd get paid to give them an answer. It would be bullshit, but we'd give them an answer. unless of course
Yeah.
we worked on the prop desk where we were tied to our answer via P&L. But like that's the world we live in. We live in a world of insecure people who have no process, who want somebody who has one to tell them when. And the answer is we don't know. But market structure can provide plenty of. I love how you explain that. I mean, it's like I'm sitting back there in 2000. One of the greatest blessings I ever had, Steve, was working in the big room. Like, working just on our own hedge fund between 2000 and 2006, I didn't know shit compared to working at Magnetar and Carlyle, where I'm a PM on a platform, right? Because what you're talking about, all that brush and all those like clues, all I'd have to do is look at what other people's P&L was doing versus mine on that day. Oh, I'm having a shit day? 90% of guys are having a good day. Okay, well, okay. And you just keep observing and observing, observing. I think that's like that's a thing, right? Experience is a thing. And I wonder, well, you don't have to wonder. I mean, that's Wall Street, right? Every bull market, you bring in a whole new cattle class of ignorant people, and they don't know where any of the brush is. And meanwhile, we're all sitting here watching it, watching it day to day, not having to know what one is going to light up first.
Yeah, look, two things, Keith. One is I keep saying to people, look, we're in the probability business, so we're in the risk management business. We're not in the prophecy business. When will people get scared? Look, I mean, everybody knew that subprime was a crazy idea, right? I mean, lending money to people who have no job, no assets, no income, to buy a house. We all knew that it was a crazy idea, but it kept on going because, it kept on going and kept on going until it didn't. Now, who would have thought that tiny little corner of the mortgage market in the United States would be the thing that caused the global financial crisis? Right. Anyone who told me that, I would have dismissed it, right? I mean, we knew it was a bit crazy. I knew a guy who in New York who got divorced and poor thing, and he was it had affected his career, and he'd been laid off. So I was like, what are you going to do? And he says, well, luckily I'm buying a house around the corner from the wife and kids. I'm like, haven't you just lost your job? And he said, yeah, but I'm borrowing. I can't afford to rent because I don't have a job, but I have been able to buy a house around the corner. I'm like, okay, that doesn't sound like a great risk management strategy, but they carried on, right? Yep. So, like I say, we don't know. But the other thing I would say is that this generational thing, I mean, you're always at risk of sounding like, the old man. I am an old man, by sense. But, in a bull market, you want someone who's fearless, right? And human psychology says that, the risk side of your brain doesn't even reach maturity until you're 25. So the person you probably want to be running in a bull market is some 23-year-old and a man, because men take more stupid risks than women, because we're complicated with this testosterone. But the number of bull market geniuses out there right now, is like frightening. But none of them are particularly interested in what you and I have to say about risk management, because look at their returns over the last 6 months or 12 months compared to mine. They're like, this is just some stupid old man who doesn't get the world's changed. Well, and I say, well, yeah, the world's changed, but humans haven't. At some point, someone's got to be wanting to take a profit. And when everyone starts queuing up, there may not be other people on the other side to get you out of your investment. Yeah. So this is really what we've built our fund around, which is, we won't do particularly well if things keep on like this, right? And I'm not saying it's certain, right? I think that it's almost certain that the next 10 years returns on, say, the S&P will be deeply disappointing if people think they're going to be anything like the last 10 years, right? Because we're already at 25 times earnings, right? So, we're already, so that's already pretty expensive. And we've gone up the market bottomed out at 666 in March of 2009, right? It's an easy number to remember. And here we are 10x now. We're just not going to do that unless the market's going to 200 times earnings. So, one of two things is going to happen. Either we're going to have a shakeout, or we're going to have a sideways market, which is either way, it's going to deeply disappoint people. So the chances that something comes along and dislocates this is pretty high. Now, if people are just looking up and saying, I want to make as much money as possible over the next, 6 months, and I'll be smart enough to know when the weather's turning, I'll be out, then we are not of any use to anyone. And I think, you want to go to younger people than us. But at some point, risk management's going to matter. And when it does, we want to be in a position where we've already got the positions we want. We don't have to go and buy them from someone else. And
well, you don't have to look very.
That's our whole philosophy.
You don't have to look very far. I mean, you and I are older, but we're not too old to play the game yet, and we're both old enough to remember February to April of this year. The U.S. stock market crashed.
Oh, sure.
The VIX went to 55. I mean, it's not like this didn't happen. I mean, crypto right now, and that's the other thing. There are plenty of bear markets that at least we're positioned for and making money in while you can be long a bull market. There's a lot of different ways to do it, but for me, like if we just go back and just go through, I mean, I looked at actually, I don't think you're allowed to talk about your numbers on Friday. I'll just say what they were. That's probably easier. But like Steve had a huge day on Friday when the market was down huge on Friday. He was up like 3%. The market was down almost 3% in the S&P 500, if I remember the number correctly. So you do well there, what a lot of people don't do well. But you have it's not like you're just going to ride those options every single day thereafter, right? You got paid that day. So,
yeah.
And then if you go back to February, yeah, the first couple days of April were very profitable for you, but it was really like a really good time to be trading, and fading the crowd for 2.5 months. And that was like, to me, like that is just, a lot of that can be born out of a lot of different things, but market structure certainly perpetuated the pace of that freakout. I mean, how do you think about that relative to the other ones? Because it's like, it's not like an unidentified object, like getting to 50 plus VIX, but it's up there.
Yeah, look, I think what we have in this buy the dip mentality is something that, there's this old story of the oak and the willow, right? Which they're having this argument, which is stronger. The oak's like, look, you're just a puny little willow. I'm this mighty oak. Now, every time you have this buy the dip, it behaves like the mighty oak, right? Which is that, it moves slightly and then it comes back. And then, the moral of the story is, when the great storm comes, the willow bends in the wind and the oak, keels over. And I think, the buy the dip trend, which is really strong, right? Now, in fact, you made 40-50% by doing that in April. You're feeling very, very, very smug about it. It works until it doesn't. So if there's something that, so if you're putting all your available capital and all your available resources into buying this dip, if you're wrong and it keeps on going, you've got nothing left, and particularly if you're doing it on leverage. So the chances that, we get, we're talking about regimes. I think we'll be in a low volatility regime generally until we're not. And then when we're not, it's going to be
really not.
Whoa, it's going to be like, it's going to be huge. And not because necessarily the economy is going to be going, downhill like as it was in 2008. But, we need our banks. And banks won't be a source of volatility for this next crisis, I don't think. But when markets become discontinuous and people have all of their chips already in, there's nothing left to stop it. So I do think that we have this phenomenon called jump to correlation, which is one of the reasons why these models don't work, right, Keith? Because they're always looking backwards. They're going, over the last 90 days, these things had these characteristics. So therefore, the risk we're taking, over the next 90 days is because now is going to be this, and that works most of the time. And then something happens, and all of a sudden liquidity is withdrawn, or voluntarily people are trying to take liquidity out all at once, and everyone's on the same side, and there's no natural people on the other side. And then, everything becomes correlated. So none of your previous risk management tools work. And so then you're in and that can happen without necessarily, a bad external event in markets. It could just happen endogenously. For those of people who are really old, they'll remember that, the stock market fell, it's unimaginable, 20% in a single day in October 1987. And that was, there was literally nothing happened. in the world to cause that, other than just it was an evaporation of support for the market, and just a massive imbalance of sellers versus buyers, and prices just fell and fell and fell. Now, people say, well, that won't happen again because the Fed would step in, and they may be right. Maybe the Fed, if markets fell 20% tomorrow, maybe the Fed would find a way of stepping in. But, once again, it's like, do you really want to rely upon the Fed to be saving your portfolio, or would you actually like to have some things in your portfolio that are going to help you out? I am worried about the structure of markets, because we haven't really had a good shake of the tree, with the exception of those 3 days in April, for a very long time. And when that happens, like I say, this brushwood does just gather and gather and gather. And I think an awful lot of people, and certainly the most successful traders in this market, are probably taking way too much risk to be described as prudent. And it's not just a question of, the Magnificent Seven or crypto or AI, the list goes on. I was looking actually about yesterday, we were talking about a stock called Beyond Meat.
Oh,
do you remember do you remember that massive bull market in non-meat products?
Yeah.
That stock topped out at a $10 billion market cap. $10 billion. So yesterday, over the weekend, they did a cram down of the debt, and I think the equity investors got diluted by 75%. The market cap of Beyond Meat now is $60 million.
Yeah.
Down from 10 billion.
It's like a penny stock.
Yeah. And you were already 90%, but then you lost half your money on Monday, and then another 20% on Tuesday. So the market cap of that company is $45 million. So, which is less than $1 billion. So it's, you can have these hyperbull markets, and it's not like people are no longer adopting a vegetarian diet. It's just sometimes these things just don't work out, and some of the mania around it evaporates. So yeah, I think right now, markets are dangerous. The problem is, because everyone, an awful lot of institutional investors are under passive investors have none, but even, active institutional investors are so concerned about underperforming the market that they're not acting as as good policers of the market. And as I say, the most disliked stocks in the market amongst the market neutral guys, they're way outperforming the average stock, which is leading a lot of people, including my head of research, to say, oh, there's no point looking at valuation anymore, the market's broken. I'm like, yeah, well, that's what you do, right? I mean, the markets, ultimately valuation will actually matter. The long-term prospects of a company will matter. This Graham Dodd, long-term investing in using value as a determinant of the value of a company actually will work again. It won't just be momentum. The question is, A, when will that happen? And B, how bad will it be when it stops? And I think the answer is, on the first one, I want to reiterate, I have no idea when, but I think the answer is, how bad will it be? It'll be a lot worse than people imagine.
Yeah, I mean, that's a great way to end it. Unfortunately, we're at the end of our time here, but that was awesome. It was a great time to meet you, and you're quite right. I mean, Howard Penny, our analyst on Beyond Meat, he would get in our morning meeting every day, talk about how it's a bubble, it's a bubble, it's a bubble. He was right, but it took a long time for that to play out to what you just said. In some ways, the more fundamental it is, the more obvious it is to more people. Therefore, it takes a little longer to find. Like you said, the effervescent when is not something you and I are in the business of prophesizing about. It's something we're in the business of executing on. So nice job getting back in the saddle with Vulpes and all that you do, because it's going to be a select few, that are going to be fine. When a lot of people aren't. And I hope a lot of people get to meet you, and Hedgeye Nation, our community here, got to meet you, obviously. But hopefully a lot of people start to interact with you, and we can have you back.
It's a great pleasure, Keith, and good luck to everyone out there. And good luck to you.
Thank you. I love saying that. Best of luck out there, right? And that you can find things in common with every human being, right? If somebody can find things in common with me, that's like really impressive. But again, the best of luck out there every day. I end the early look with that. I have for 18 years. Best of luck out there. Up next, if you want to get the really somebody to scare the hell out of you longer term, I got the guy, Neil Howe. He's coming up next.